Hello and welcome to this episode of Your Financial Planet, a podcast hosted by the Synergy Capital Solutions team. Join us while we share our journey as we navigate life's complexities and provide solutions to reduce the noise around your personal financial situation.
Hello, I'm Synergy's Director of Investments, Eric Nahat, and welcome to our second quarter 2025 recap and third quarter 2025 outlook. We hope that everyone has had a great start to summer. Our team continues to be thankful for the opportunity to help our clients achieve their goals. This slide graphs the S&P 500 during the second quarter, highlighting how major political and economic events influence the stock market. Here are the key points. Over the past 3 months, the S&P 500 experienced significant volatility, primarily due to large and frequent shifts in trade policy. The volatility started the first week of April after the White House announced widespread global tariffs at an event called Liberation Day. Markets reacted swiftly, with the S&P 500 falling more than 10% over 4 trading days as investors worried about the supply chain disruptions, rising inflation, and slower economic growth. However, the sell-off proved to be short-lived, with April 8th marking the second quarter market low. The positive momentum started April 9th, when the White House paused its reciprocal tariffs for all trading partners except China. The S&P 500 gained nearly 10%, one of its strongest one-day returns in history. The stock market gave back some of those gains over the next week, but equities went on to steadily climb throughout Q2 as trade tensions de-escalated. The S&P 500 posted a 9-day winning streak in late April, and on May 12th, the US and China announced an agreement to stabilize near-term trade relations. The stock market's rise slowed considerably in the second half of Q2, with the S&P 500 drifting higher from mid-May through the end of June. Meanwhile, headlines kept coming. The credit rating industry Moody's downgraded the U.S. credit rating due to fiscal issues. The U.S. Court of International Trade ruled tariffs unconstitutional, and geopolitical tensions rose in the Middle East. The first half of 2025 was busy and eventful, but for all that happened, the S&P 500 managed to return over 6% and end Q2 at an all-time high. For those not following the market closely, it might seem as though little has changed. This slide puts the stock market's Q2 rebound into historical perspective. It graphs the Nasdaq 100's rolling 2-month return from 2000 through 2025, with the far right showing the index surge over 25% from April 4th to June 6th. The rally marks one of the indice's strongest short-term gains and ranks in the top 1% of all 2-month returns since 2000, highlighting the rapid improvement in investor sentiment as trade tensions eased. Looking back over the past 25 years, similar short-term gains of 25% or more have occurred around major market events such as the 2000 dot-com era, the 2008 financial crisis, and the 2020 pandemic. In each case, the steep sell-off was followed by a powerful short-term rebound. The historical pattern reinforces a recurring trend. Major stock market declines are often followed by large bounces. The 2025 rebound stands out as one of the strongest, placing it alongside some of the most dramatic turnarounds of the past quarter century. It also reinforces the idea that while volatility can be unsettling, it can create meaningful investment opportunities. This slide recaps the year's major trade policy developments. The table lists key trade policy changes in chronological order, including effective dates, trading partners, and a description of the policy and the associated tariff effect. This year has been defined by large, frequent shifts in U.S. trade policy. There were periods of increasing tariffs and targeted actions against trading partners, followed by exemptions and temporary agreements. While the first quarter was marked by trade escalation, the second quarter saw a significant shift towards de-escalation. The escalation started in February and March with targeted tariffs on imports from China, Canada, and Mexico, along with broader duties on global steel, aluminum, and auto imports. Tensions peaked in early April with the announcement of sweeping tariffs on most imports. However, the tone quickly shifted a week later to de-escalation when the administration paused reciprocal tariffs for all trading partners except China. By early May, the White House announced a trade agreement with China, signaling a further move towards easing tensions. While Q2's de-escalation efforts lowered tariffs from the initial extreme levels, uncertainty remains. In late May, a U.S. trade court ruled the tariffs unconstitutional, and by early June, the administration was weighing new tariff actions. As of July and August deadlines approach, the policy environment remains fluid, with key details around the April reciprocal tariff pauses still unresolved. Businesses and trade partners are left to navigate a landscape where the long-term outcome is unclear and subject to both legal challenges and changing political strategies. This uncertainty is likely to persist in Q3 for businesses and consumers. This slide highlights another consequence of trade uncertainty, the impact of tariffs on inflation expectations. The charts compare U.S. consumer inflation expectations against realized inflation from 2016 through 2025. On the left, survey data from the Conference Board and the University of Michigan show a sharp uptick in consumer expectations this year. On the right, the Consumer Price Index shows prices remain stable and on a downward trajectory. The takeaway? While consumers are bracing for higher prices, actual inflation data shows tariffs have not translated into measurable price pressures yet. The sharp rise in expectations appears linked to the rollout of new tariffs, which have raised concerns about rising costs for imported goods. However, these fears haven't materialized in the official inflation numbers so far. Economists caution that May's inflation report may not fully capture the tariff's impacts, as it takes time for supply chains to adjust and companies to pass through those price increases. This has sparked a debate about the path forward. One group believes companies will raise prices and pass through tariffs, while the other thinks firmly that the firms will observe higher costs to remain competitive. As a result, some warn that more pronounced inflationary effects could show up in the data in the coming months. Economists and policymakers are monitoring this gap between perception and reality closely, as it could shape future consumer behavior and influence the Federal Reserve's actions. Tariffs and trade policy uncertainty have also influenced Fed policy. The central bank faces a difficult policy trade-off. Tariffs could lead to higher inflation, but they could also slow economic growth if higher prices reduce demand for goods and services. Given the uncertainty, the Fed held interest rates steady at its May and June meetings, reiterating that it wants more data before deciding on interest rate cuts. The slide shows the market has largely adopted the Fed's wait-and-see approach. The figure graphs the market's rate cut forecast through the end of 2026 based on current Fed futures pricing. The Fed's current target range is 4.25% to 4.5%. The chart shows the market expects a gradual near-term decline rates, with the first anticipated cut occurring in September. The pace of rate cuts is then forecast to increase in Q4 and continue throughout 2026. Looking ahead to December 2026, the market expects the Fed to lower interest rates by approximately 1.25% over the next 18 months. Based on current market pricing, investors expect the Fed to lower interest rates at a modest pace. This likely reflects the inflationary risk from tariffs, but also their limited economic impact thus far. It's important to note that this represents the market's forecast as of mid-2025, which will likely change based on incoming data and future trade policy developments. The timing and the size of Fed rate cuts will ultimately be determined by inflation and the economy's trajectory. This slide provides an update on the S&P 500's earnings and valuation multiple. The chart on the left graphs analyst estimates for the index's 2025, 26, and 2027 calendar year earnings. Since the start of this year, S&P 500 earnings estimates for all 3 years have been revised lower, reflecting increased policy uncertainty. Despite the downward revisions in the first half of the year, estimates remain relatively solid and are down only around 3% year to date. The impact of policy uncertainty is also forecast to be relatively short-lived, with Wall Street analysts expecting continued earnings growth in both 2026 and 2027. The chart on the right is a sensitivity matrix. The S&P 500's price is a function of two variables: one, earnings, and two, what valuation the market is willing to pay for those earnings. A higher index price can result from higher earnings, a higher valuation multiple, or a combination of the two. The matrix shows forecasted earnings along the top and valuation multiples along the side, helping to visualize how different combinations could impact the index's price. As of June 30th, the S&P 500 traded just about 6,200 based on the next 12-month earnings estimate of around $280 and a valuation multiple of around 22 times earnings. While the current valuation multiple is high, it doesn't necessarily mean the market will underperform. Instead, it suggests equity prices are more reliant on fundamentals going forward, such as expanding profit margins and continued earnings growth. If the tech sector earnings are stronger than forecast and/or tariffs have limited economic impact, higher earnings and valuations could push the index higher. However, if trade tensions escalate, earnings are weaker than expected, economic data softens, it could lead to a growth scare and cause stocks to trade lower as valuations correct. Alternatively, the S&P 500 could move sideways if earnings come in line with expectations and there's no clear directional driver. It's important to emphasize that this is a theoretical exercise, and actual results will depend on what happens in the coming months and quarters. However, it's helpful to think through the various scenarios and their potential impact on the stock market. This slide highlights 3 themes to watch over the next 6 months, each of which is tied to policy uncertainty and tariffs. The first theme is Fed policy. Last fall, the Fed cut interest rates by 1% as unemployment rose, but it has since paused rate cuts due to concerns about potential inflationary impacts of tariffs. The central question is when the Fed might resume interest rate cuts and how much more it could lower rates. If inflation rises, the Fed might move slower than expected and keep rates elevated. However, if tariffs slow the US economy, the Fed might speed up rate cuts. The Fed's decision will have wide-ranging implications for growth, borrowing costs, and financial markets. The second theme is the risk of tariffs translating into goods inflation as import costs rise. Goods inflation eased in 2023 and 24 as supply chains normalized and oil prices declined, but it has since recently shown signs of rising again. As discussed in a prior slide, tariffs have not translated into measurable price pressures so far, but there are concerns that they could in the coming months. The key question is whether goods inflation will rise, and if so, whether it's temporary or the start of a new trend. The third theme is the impact of tariffs on corporate earnings and economic growth. Tariffs and the back and forth headlines have created significant uncertainty for businesses, making it difficult to forecast demand, plan and invest, and manage operations. The big question is whether companies will absorb the increased costs to remain competitive or pass them on to consumers. Absorbing costs could compress profit margins, while passing them along could weaken consumer demand and slow economic growth. The 3 themes are interlinked. Tariffs could impact inflation, corporate earnings, and economic growth, all of which would influence Fed policy. The market and policymakers will be watching developments in the second half of 2025. We've discussed a range of key investment themes in the webinar as the market navigates uncertainty around trade policy, inflation, and corporate earnings. To conclude, we want to step back and look at the bigger picture of past economic cycles. This slide graphs the duration of prior economic cycles since the 1940s. Each group represents a specific economic cycle, starting with the year the expansion began. The dark blue bars show the number of months the economy expanded, and the light blue bars show the length of the following contraction. As determined by the National Bureau of Economic Research, a clear pattern emerges across cycles. Expansions tend to last much longer than contractions. The average expansion lasts 65 months compared to only 10 months for the average contraction, with the chart showing expansions have lengthened since the 1980s. It's impossible to know when the next contraction or recession might take place, but history provides helpful context. Economic downturns are a natural part of the business cycle, but they tend to be brief compared to the extended periods of growth that precede and follow them. Several structural forces contribute to expansions being longer. Population and demographic growth naturally boost demand for goods and services, leading to a cycle of business investment and hiring that sustains economic growth. New technologies also play a role, leading to increased productivity that allows businesses to produce more goods and services faster and cheaper. These advances spark innovation and extend the length of economic expansions. If we think about why we're investing for the long term, this chart provides a great summary. The overall picture is one of long-term economic growth punctured by brief downturns. Our team is monitoring each of these themes discussed in the presentation, ranging from the risks that tariffs pose to inflation, economic growth, and corporate earnings, to the potential benefits that artificial intelligence could have on productivity and profit margins. Thank you everyone for joining us, as we hope this has been insightful into the market themes our team is following as we work hard to manage your family's wealth alongside ours. For our current or prospective clients, you can always get in touch with the team by contacting hello@synergycapitalsolutions.com. We look forward to seeing you soon. Thank you.
Thank you for listening to Your Financial Planet. Please press the like button below if you enjoyed this episode, and hit the subscribe button so you can stay up to date on all our future episodes. The team at Synergy Capital Solutions is always here for you. Reach out to us via email at hello@synergycapitalsolutions.com, or you can call us at 888-363-4546, or check out our website www.synergycapitalsolutions.com. Synergy Capital Solutions is a group comprised of investment professionals registered with Hightower Advisors LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors LLC. Securities are offered through Hightower Securities LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data and other information referenced herein is from a source believed to be reliable. Any opinions, news, research, analysis, prices, or other data or information contained in this presentation is provided as general market commentary and does not constitute investment advice. Synergy Capital Solutions and Hightower Advisors LLC or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or competitiveness of the information or for the statements or errors or omissions or results obtained by the use of this information. Synergy Capital Solutions and Hightower Advisors LLC assume no liability for any action made or taken in reliance or relating to any way of this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purpose only. The opinions expressed herein are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates.